Welcome back to the special edition of Money, 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 where we have a power-packed panel that's telling you how to shape up your financial life, your personal finances for the year 2016-17. Now, we were just discussing, of course, what the general trends of the year might be. But, Nilesh, one of the big features is going to be, of course, looking at this new environment where interest rates are falling. So for an investor who's looking at obviously equity, but also wants a little bit of debt in that investment thali, what's the best bet now?
I think looking at our inflation trajectory, it will be fair to assume that for the foreseeable future, interest rates will remain subdued. And that's going to have an impact on people who are only investing in fixed income. If you have an opportunity, go and lock yourself into the longest possible bonds which is available today, because hopefully after 1 year or 2 years, when you want to invest, this returns will be even lower. The second thing which people need to remember is that while you are investing into the longest possible duration bond, you also need to take some more risk, especially on the hybrid side, if not on pure equity side, in order to overcome this falling interest rate syndrome. Clearly, we have seen globally that when interest rates go to negative, the worst sufferers are the pensioners or the retirees who haven't allocated to risk assets. Now, I'm not saying that in India we'll see in the foreseeable future negative interest rate, but the fact is that as our inflation has remained on the higher side compared to Western world, and as interest rates are declining, a lot of our pensioners, retirees are either thinking that their next generation son, daughter, they will be their retirement solution, or bank fixed deposits and tax-free bonds and PSU bonds will be their retirement solutions. I think they need to be cognizant that next generation may not be a good retirement solution. And second, they need to blend little bit of risk, at least to create a hybrid mechanism.
And that's where the twist comes in, because while a lot of investors traditionally in India are very comfortable with small saving schemes and rates there are also falling, they're comfortable with the bank fixed deposits. The understanding and awareness about the debt market and how to invest in it and what one should keep in mind, that is still lacking to an extent. So if you are advising someone to also start looking at certain hybrid instruments, as you said, or certain debt mutual funds, what kind of funds should we talk about? And how would then they rate with a pure vanilla FD, or let's say, a small savings scheme like a PPF or a senior citizen scheme?
So in the bank FD, typical maturities which people go is up to 3 years or 5 years, which creates a rollover risk. 5 years down the line, you never know where the deposit rates will be. Second is the taxation of bank FD. Now compare that vis-a-vis, let's say, duration fund like gilt fund. They are far superior in terms of credit risk, and because fund managers take duration call, they tend to deliver volatile return, but sometimes they exceed bank fixed deposits by a big margin.
If you stay in at least 3 years or longer, I'm guessing that's the advice.
It's basically function of interest rate cycle, but over 36 months probably one cycle will come to an end. The second opportunity which is available today and where there is a fair amount of risk in the mind of investors is credit opportunity funds. These funds today have lower double-digit coupon return, and obviously there is some amount of risk in terms of credit, and in the past we have seen a couple of these funds facing credit situation. But if you see over a longer term, the track record of these funds vis-a-vis bank fixed deposits or a tax-free bond or a PSU bond is fantastic. Now, my feeling is that at some point of time, as mainline interest rate starts coming down, opportunity will be there in credit opportunities fund. You have to select right credit opportunities fund. You still have to have a time horizon properly, and you need to have that comfort that even if there is a minor mishap here or there, you will not redeem.
Okay. So, Gaurav, comment on this. Now, for people who might be coming to you saying that I want to be in debt, but I want to be in a smart debt instrument, So what are the sort of caveats that you need to keep in mind? And some of the funds that Nilesh also mentioned, are they for the more high risk or, risk-prone investors? Should people with average risk actually avoid them and stick to bank FDs?
So here it is. I mean, if you're looking at debt fund, then once you're more or less okay, leave it to fund manager, because you can't be getting into a situation where the fund manager has picked up which are the underlying papers and why are you doing that. You're paying fund manager and trust him. I mean, at the most you may want to know at the time of investing what is the philosophy or whatever. If you're picking up a debt instrument on your own directly, which could be a bank FD or certain bonds or whatever, then Then you want to look at the credit rating, you want to look at it secured, unsecured, if it's secured by what kind of assets. If they're giving you slightly higher rate of interest, is it really worth taking that risk? Because so many times we see these corporate bonds, corporate FDs for a retail investor, which is giving you 1 or 2% more. But is it really worth taking that risk? Because the amount of money that you're investing is probably 50,000 or a lakh of rupees. So when you translate that into post-tax returns, it's hardly anything. So all these factors that needs to be looked into when you're doing it directly. You want to look at liquidity as well. So a lot of these tax-free bonds are now listed on stock market, but there may not be enough deals happening, so you may not be able to get that. A lot of these things needs to be looked into when you are looking at investing directly into a debt instrument, which is besides FD. Sure. Even if it's an FD, lot many times we see a mismatch. So for example, I have my situation could be that somebody has daughter's higher education expense coming up in 6 months and has picked up a 3-year FD. Now, it's a mismatch. Nowadays it's easier to break a fixed deposit or just write a check and they break it. But why do that? I mean, look, kind of plan in a manner that you don't have to do interim redemptions as far liquidation as far as possible. Ensure that the liquidity is easier, the ratings are good, there is safety, because every time some news comes up or a particular paper going down or something, and then people are worried, oh, I've invested in this debt fund and they have invested. Why get into that? I mean, we are investing into debt instruments, so at least you want peace of mind as far as your principal is concerned. It will lose to inflation. But even if that's going to cause you stress, then you better be careful.
So it's really about individual risk appetite. From the taxation standpoint, Mayur, which debt instrument will be most tax efficient? I mean, we know that you put your money in the public provident fund, it's exempt, as good as it gets. Let's leave that out and compare the other instruments that are available, including debt mutual funds.
So, my guess is that debt fund generally does not offer any tax efficiency except the tax-free bonds. Unless we are looking at a growth fund where eventually we want to, rather than redeem it, sell it in the market. And that's where, you can, leverage on the lower rate of taxation as opposed to full rate of tax. Let me give you an example that, you offload your mutual fund, debt mutual fund in the market. Consider it to be a long-term capital gain pay tax at the rate of 20% as opposed to after redemption you will pay a little more tax than
a lot of planners advocate these funds because you get the benefit of indexation also. So on that capital gains tax, you apply indexation and then your tax outgo really reduces.
It reduces, that's right.
So is this the instrument that sounds most efficient to you?
That is more tax efficient than the normal one.
Okay, fair enough. So this is a lot about debt mutual funds, but Nilesh, coming to some other aspects as well. If we're actually thinking of wealth creation this year, there's equity, we've spoken of debt. Where do you think gold and even physical real estate stand in the pecking order for this year?
So on the debt side, I'll just want to add one thing. That I haven't seen a person becoming richer by investing in bank fixed deposits. You can't become billionaire by investing in bank fixed deposits.
You can barely cover your expenses during your retirement years,
So we need to be cognizant of this fact that when we are looking at the safety of debt, it does provide protection, it does provide safety, but then the cost is, you are losing out in terms of return against inflation. On the gold side, towards the beginning of the year, we had a bullish call. We thought gold, after so much of correction of about 48%, will bounce back. And we have seen some amount of recovery in gold. Now, today, for an investor to take a view on gold, he has to be remembering two things. One, gold prices have 10% import duty. Now, God forbid, tomorrow government decides to reduce this to zero, as was the case in the past, you will lose 10% of your principal investments in one single day. When you invest in stock, you could lose 10%, but in gold, if the import duty becomes zero, you certainly lose 10%. The second thing, which from a country point of view, if we see, we are already the largest importer of gold in the world. If we decide to sell gold, who will buy from us? Most people believe that, the jeweler which gives a put option of gold, that I will buy back jewelry, what you have purchased from me. I mean, they don't realize that his entire stock is financed by banks or other people. how can I trust him that when I come back to sell my jewelry, he'll be able to buy it back? If 5% of his customer return to give jewelry, the jeweler will close the shop and run away. So do invest in gold, but do remember that this 10% import duty can hit you very hard. And second, the liquidity of gold is a suspect. So it is liquid only because no one is selling it. The day people try to sell, there will be no liquidity.
There will be everybody heading to the exit door. So in our investment thali that we spoke of at the beginning, how much allocation would you give? 5% to the portfolio or even lesser than that?
For an average investor, I will say don't, because your wife or your mother has already invested enough in gold, which you are not probably aware of.
Okay, fair enough.
So just one more question it arises, is that how does gold bond vis-a-vis gold, would you look at it?
There are a lot of different options through which you can now invest. And there are gold ETFs, there's a gold bond scheme that the government launched, and then of course there's physical gold. So
I'll rather recommend people to use gold monetization scheme.
Yeah.
It's a slightly tougher game. It requires a lot of processes to go through. But I think gold monetization scheme, which allows you to, liquidate your existing gold, get return on it.
That's if you can get your wife to part with her jewelry.
Absolutely. I haven't convinced my wife to do that, but I'm sure there will be some other brave people.
Oh, brilliant, brilliant. Well, on that note, we'll take another quick break. On the other side, retirement planning. So much is being spoken about the National Pension Scheme. Is that the best route to planning for your retirement in your silver years? We'll come back and discuss that.